Welcome to the Pro Ticker Deep Dive. We are jumping straight into the engine room of decentralized finance today. We're looking at the two titans of smart contract platforms, Ethereum, or ETH, and Solana, SOL.
That's right. And for so long, the main view on these was just pure speculation, high-octane stuff.
Exactly. But what our sources are revealing now is something, well, way more interesting. A kind of dramatic maturation where real institutional structures are being built around them.
And the data tells a wild story.
It really does. I mean, to give you an idea of the disparity, by late 2024, our data shows Solana was registering active users at 24 times the rate of Ethereum's main layer.
24 times. You have to ask, how is that even possible?
That's what we're here to do.
And that's really our mission for this deep dive. We want to synthesize the hard facts, the technical differences, the new institutional access points like ETFs and futures, and of course the on-chain fundamentals.
Right.
The goal is to give you, the listener, a complete picture of why these two assets are positioned so differently in this cycle. It's about the structural changes that are driving their real value, beyond just the hype.
And we have to acknowledge the scale here. ETH is the established giant, right? The second largest crypto asset market cap is usually, 40 to 60% of Bitcoins?
A true behemoth. And then you have Solana.
Solana had a brutal 2022, but it's staged this phenomenal, almost unbelievable comeback. It's rocketed back into the top 10.
It really has.
Okay, let's unpack this, starting with the leader. What is the unique investment profile of Ethereum right now?
Well, what's fascinating with Ethereum is that it operates in this really sophisticated dual market.
A dual market.
Yeah, you've got the speculative side, all the trading, derivatives, price action, and then you have this underlying utility market. And that second market is driven by, real demand for the network itself. For block space, we're talking gas fees, dApps, DeFi transactions.
So it's not just an asset you buy and hold. It's a living economy where ETH is both the fuel and the money.
Precisely. It's the absolute backbone for DeFi, for NFTs, for the whole stablecoin ecosystem. And you can see this real-world demand in the liquidity data.
Okay.
Decentralized exchanges on Ethereum, like Uniswap, are massive. They regularly rival the volume of mid-tier centralized exchanges. That shows just how deep and persistent the on-chain liquidity is, which is a powerful structural underpinning for the whole thing.
And speaking of structures, how are traditional finance institutions actually getting into this? Are they just buying ETH on Coinbase, or is it more mature than that?
Oh, it's way more mature. The institutionalization angle is profound, and it's sort of mirroring Bitcoin's path, but with a unique ETH twist.
Okay.
We've seen this consistent, really aggressive growth in CME ETH futures. They've hit nearly $20 billion in open interest.
$20 billion? That's not retail money.
No, that's serious commitment from fund managers and trading desks.
Yeah.
People need regulated exposure. And then, of course, you have the ETF race.
Right. The U.S. allowed futures ETFs in late 2023.
Exactly. And now speculation is running high for a U.S. spot ETH ETF, potentially coming in 2026.
And if that follows the Bitcoin path, that would be massive. But Ethereum has something Bitcoin doesn't, that yield from staking. That must be hugely attractive.
It fundamentally changes the calculus for institutions. Staking provides this bond-like yield, around 4 to 5% annualized.
Which is perfect for a yield mandate.
It makes ETH far more palatable to endowments, sovereign funds, you name it. And get this, by late 2025, our sources show over 30 million ETH, that's a quarter of the total supply, was locked in staking.
A quarter of the supply, just locked away.
Lock away.
Yeah.
And that's crucial because it slashes the tradable float. So even modest new capital coming in can have a really outsized impact on the price.
That dynamic, where yield reduces supply, brings us right to the whole ultrasound money narrative. Can you explain simply how network usage actually affects the supply of ETH?
Yeah, this all comes down to the EIP 1559 upgrade from 2021. The simplest way to think of it is a continuous protocol-level buyback mechanism.
A buyback. Okay.
So when the network is busy, gas fees go up.
Yeah.
And a portion of those fees is permanently burned, just gone forever, removed from supply.
And this is where it gets really interesting.
This is where it gets really interesting.
Yeah.
This system has led to entire months where Ethereum's net supply actually decreased. Our sources track over 300,000 ETH burned annually on average since the upgrade. It can make the asset deflationary.
A deflationary productive asset. That's a powerful structural advantage.
It is.
Now let's talk scaling. We noted that active address growth on the main layer, the L1, has kind of plateaued. If the activity is moving elsewhere, doesn't that suggest the foundation is failing to keep up?
That's a super common misinterpretation, but the sources actually argue it's the opposite.
How so?
The plateau on L1 isn't a bug, it's a feature of Ethereum's modular approach. The activity has just migrated to layer 2 networks, Arbitrum, Optimism, zk Sync.
So the L2s handle the heavy traffic.
Exactly. They handle the high-volume stuff cheaply, and the L1 remains this incredibly secure, decentralized settlement layer. It's about scaling without compromising on security.
Okay, so the L1 is the secure bank vault, and the L2s are the express lanes for daily transactions. I get that. But every strength has a risk. What are the key weaknesses here?
The primary risk, ironically, centers on centralization within staking. It ties right back to that attractive yield.
Right.
While Ethereum is decentralized, in theory, in practice, Leo, the big liquid staking provider, and the major centralized exchanges, well, they combine to control about 60% of all staked ETH.
60%, that's a big number.
It's a huge number, and it raises legitimate concerns about censorship resistance. If governments pressured those few large custodians to, say, block certain transactions, it creates a systemic choke point.
A single point of failure, almost.
Almost.
Yeah.
And then there's just the complexity. Ethereum's architecture allows for incredible innovation, but it also means a much larger surface area for bugs compared to simpler chains.
Complexity and concentration, the price you pay for that utility. Okay, let's shift gears. If complexity is ETH's trade-off, let's talk about the high-throughput contender. Solana. So many people wrote SOL off after FTX. What does the data show about its comeback?
The turnaround is, it's the story of this cycle. After 2022, a lot of people thought Solana was finished. They assumed the FTX connection was a death blow.
I remember that narrative well.
But institutional capital clearly started to reconsider. In 2025 alone, Solana investment products saw $3.6 billion in inflows.
$3.6 billion.
Yeah, a 1,000% increase year on year, mostly from European ETPs and private funds. And just like ETH, the CME launched Solana futures in early 2025, giving it that regulated derivatives market.
But the sources also suggest Solana's market structure is way more sensitive to retail. It's the home of those high-octane bets.
Absolutely. You saw this so clearly during the meme coin mania in early 2025. Solana DDEX volumes just exploded. They hit an all-time high, and for a short time, they were even challenging Uniswap on Ethereum.
And that's all fueled by Solana's core tech, right? The speed and low cost.
Exactly. It allows for this kind of high-frequency betting and immediate participation that just defines a retail-driven market.
And that brings us to the usage metrics. That 24x active address, number 15 million on SOL versus 600,000 on ETH-L1, how much of that is real usage versus, bots or wash trading?
That is the critical question. And while some of it is definitely automated traffic, the sheer volume reflects Solana's architecture.
Okay.
Because the fees are basically zero and finality is sub-second, you can actually build things that just aren't viable on other chains. Things like high-frequency trading, Solana Pay for consumers, gaming apps. It's a very different model.
So it's building a consumer-facing ecosystem, which just naturally has more transactions.
Precisely. It's not about high-value financial settlement like Ethereum. It's about high-frequency consumer interaction.
But the big headwind for Solana was always reliability. The outages were notorious. If institutions are pouring in billions, they must have fixed that.
Right. This is the pivotal breakthrough. The innovation is called FireDancer.
FireDancer.
It's an entirely independent validator client built by Jump Crypto. It went live in late 2024. See, before FireDancer, nearly all validators ran the same software. It was a monoculture.
So one bug takes down the whole network.
Exactly. FireDancer is like a completely separate operating system running the chain. It just crushes that single point of failure risk.
Like having two different operating systems. So if one fails, the other can keep things stable. How far along is that diversification?
It's accelerating fast. The original client still holds about 70% of the stake, but FireDancer is growing and already has around 30%. And in demos, it's handled up to 1 million transactions per second.
1 million? Wow.
It has massively reduced the instability fears that plagued Solana in 2022.
Okay, so we talked about Ethereum's trade-off being complexity for security. What is Solana's core trade-off, the price it pays for that insane performance?
Solana's trade-off is performance versus decentralization, or at least participation size.
Yeah.
It's monolithic design. It does everything on one layer, requires extremely powerful hardware for the nodes. This is a deliberate choice for performance, but it means you only have about 1,900 validators compared to hundreds of thousands on Ethereum.
Because it's too expensive for most people to run a node.
Right. You need professional, expensive machines. It limits who can participate in securing the network.
And what about the tokenomics? We know Ethereum can be deflationary. What's the story for SOL?
They're polar opposites.
Yeah.
And this is so crucial for you to understand. Solana has a pre-programmed inflation schedule, currently running between 5 and 8% a year.
So the supply is always increasing.
Always increasing, though at a decreasing rate. It means SOL's value proposition relies heavily on sustained exponential usage growth to outpace that supply increase. It's not about scarcity.
And zooming out to the macro picture, how does SOL behave compared to ETH?
They're both highly correlated with tech stocks, but SOL acts as an ultra-high beta play. Meaning, if you think we're heading into a risk-on environment, the data suggests SOL is structured to amplify those gains way more than ETH or Bitcoin. But the reverse is also true.
It amplifies the pain on the way down.
Brutally. We saw drawdowns of over 90% in the 2022 bear market. It's not for the faint of heart.
So, synthesizing all of this,
Right.
what are the key takeaways for you, the listener, trying to navigate this market?
I think first you have to pay attention to the right metrics for each chain. For Bitcoin and Ethereum, the signals are increasingly institutional. ETF flows, CME open interest, regulatory filings. They move slow, but with a lot of inertia.
And for Solana?
Solana is still incredibly sensitive to retail. If you want to spot an early move in SOL, you need to monitor social media, DEX volumes, active addresses. Those are the things that can foreshadow a retail-driven rally.
Institutional inertia versus retail dynamism? That's a great distinction. What about liquidity?
Liquidity fragmentation is critical. Our sources show DEX has hit about 20% of the total spot market share by late 2025. That means if you only look at centralized exchange order books, you are missing a huge piece of the puzzle.
So true price discovery is happening across both CEX and DXs now.
You have to watch both.
Looking ahead, say, 6 to 18 months, what are the outlooks here?
For Ethereum, the outlook is robustly optimistic. It's expected to potentially outperform Bitcoin as that utility narrative really takes hold.
Yeah.
The staking yield, the fee burn, and of course the potential US spot ETF is the huge catalyst on the horizon.
And Solana, the high-risk, high-reward play.
For Solana, it's optimistic but volatile. It could really solidify its position in the top 5. The conditions are flawless execution, so no major outages thanks to FireDancer, and a breakout consumer app. If those happen, its high beta structure means a doubling or tripling in price isn't out of the question in a bull cycle.
Finally, what's the biggest blind spot the market is still correcting for?
2 things, really. First, the Solana stability issue. The market's memory of that was long, and I think the recovery and the impact of FireDancer really surprised a lot of people who had written it off.
And the second?
The Ethereum supply narrative. It's still often misunderstood. Many generalist investors still see it as just another inflationary crypto asset, but its deflationary potential is a structural game changer. The data tells a very different story.
So here's where it all leads for you. Ethereum is aiming to be the secure, robust, modular settlement layer for the digital economy. It's the foundation. Solana, on the other hand, wants to be the high-speed engine for mass consumer adoption. The crucial question you need to keep exploring is whether both of these specialized visions can thrive in a multi-chain world, or if the market eventually forces them into a head-to-head battle for dominance. We will definitely be watching the data on that. Thank you for supplying the material for this deep dive. See you all in the next Pro Ticker Deep Dive.